So the market is reaching a pivot point. So we're starting to see signs of several data points finally merge together, and it's leading to a future housing direction. We've kind of been in this standby with markets for the past 2 years, right? Interest rates went from 3 all the way up to 7. Home values skyrocketed in 2020, 21. Some saw 20, 30, 40, 50% appreciation, kind of stalled out. Now we're finally starting to see everything come together. So what I want to talk about is several things today. The first thing I want to start with is inventory. Single-family homes listed for sale reached up to 497,000 this week. That is up 16% from the same week last year, which was only 430,000. So think about that. 67,000 more single-family homes are available for sale now than at the same point last year. However, for context, so for all the people who think, oh, inventory is rising so much, we're going to see home values plummet. Not going to happen. Again, for context, about over 900,000 homes were available for sale in 2015. So we're still a wide ways away. That being said, we're starting to see all signs of inventory pointing up. We're seeing that direction. And again, it's starting to look at it from the listing standpoint. So we had over 51,000 listings hit the market last week. The same week last year, only 44,000. So again, we're up 15% from the same week. So sellers are finally starting to sell. So yes, the interest rate lockdown theory did play a factor in our market, but we've also seen that duration just does matter, and people are finally starting to list their homes. And again, for anyone that's thinking, oh, hey, this is going to lead to a very massive collapse in home values like 2008, 2009, for context, 2008, 2009, we're seeing 250,000 to 400,000 weekly homes hitting the market each week. So again, only at 51,000, which is greater, again, by 7,000 than last week, but still 200,000 less than those crazy markets that we were seeing in 2008, 2009. So again, all signs pointing to higher inventory, which is great, which is what we need. Now, the big wild card we're still seeing is interest rates. So the 10-year Treasury, which, as you know, derives mortgage interest rates, has been at this pivot point of 4.30. Tomorrow, we have the PCE index coming out, which is the Fed's preferred inflation report. This data report has the ability to move interest rates by 50 bips, 100 bips, and for those who don't speak mortgage jargon, that's essentially maybe 1/4% in interest rate, 0.5%, and essentially it also gives us the direction, the sign of where interest rates may be heading over the course of the next 30 to 60, 90 days. Again, still a believer here. Over the course of 6 months, 9 months, 12 months, 18, 24, 36 months, interest rates will be coming down. But it doesn't mean they're going to come down next week. It doesn't mean they're going to come down the following month. It doesn't mean they're going to come back in the next 60 days, right? And this PCE report does matter, because what we're seeing is a softening in demand right now. It's because interest rates are above 7% and home values are still quite high. So home values actually only increased 1%. Month over month, and only 1% or a couple percent from the year over year. But we're starting to see it start to soften. So for those buying, doesn't mean that home values are going to increase drastically, which isn't a negative thing, right? I do believe here at Secure Choice Lending, we believe home ownership is incredibly important for so many reasons. You're not going to buy now. Again, this isn't 2020 where you're buying now and homes are going to appreciate 40%. That time's gone. But for sellers, also to understand, again, more sellers are hitting the market, but just understand that concept that yes, home values are not going to go up just much more. So if you're like, oh, I'm trying to time it perfectly and sell at the top, that could be here. And it's just because demand is weakening. And demand is weakening because interest rates are higher. So we're just seeing this problem where people are just having a difficult part qualifying. And now we're saying, okay, well, if interest rates spiked even higher with this PCE report, that's going to make it even more difficult to qualify, which is going to lower that demand from the buy side, which is going to weaken all the advantages for the seller because there's not as many buyers in the market. Vice versa, PCE report comes in good, lowers interest rates, maybe we get back to that market. So we're starting to see the softening in demand, so the softening in price. Again, not saying home values are crashing or lowering. We're just saying should stall out here at these current exact numbers. Should stall out realistically over the course of the next 3 to 6 to 9, 12 months. So you're not going to see major home appreciation, but it's a good thing. It's much and more important, and it's much healthier for our housing market. So stay tuned. Tomorrow's PCE report, followed by next week's labor market data, has the ability to move interest rates significantly over the next few days.